The crash of 1929. The history of the slump begins about 1927, when France stabilized the franc de facto at a level at which it was devalued and undervalued. This led to a great demand for francs. The Bank of France sold francs in return for foreign exchange. The francs were created as credit in France, thus giving an inflationary effect, which can be seen in the behavior of French prices in 1929 to 1928. The foreign exchange which France received for its francs was largely left in that form without being converted into gold. By 1928, the Bank of France found that it held foreign exchange to the value of 32 billion francs, about $1.2 billion. At this point, the Bank of France began to transfer its exchange holdings into gold, buying the metal chiefly in London and New York. Because of the inadequate gold reserves in London, a meeting of central bankers in New York decided that the gold purchases of France and Germany should be diverted from London to New York in the future, July 1927. To prevent the resulting outflow of gold from having a deflationary effect, which might injure business, the New York Federal Reserve Bank dropped its discount rate from 4% to 3.5%. When the French gold purchases became noticeable in 1928, the Federal Reserve Bank adopted open market operations to counterbalance them, buying securities to a value equal to the French purchases of gold. As a result, there was no reduction in money in the United States. This money, however, was going increasingly into stock market speculation rather than into production of real wealth. This can be seen from the following table of indices of average stock prices from both England and the United States in the years indicated. Industrial share prices, 1924 equal to 100. Year, 1924. United Kingdom, 100. United States, 100. Year, 1925. United Kingdom, 109. United States, 126. Year, 1926. United Kingdom, 115. United States, 143. Year, 1927. United Kingdom, 124. United States, 169. Year, 1928. United Kingdom, 139. United States, 220. Year, 1929. United Kingdom, 139. United States, 270. Year, 1930. United Kingdom, 112. United States, 200. Year, 1931. United Kingdom, 87. United States, 124. Year, 1932. United Kingdom, 84. United States, 66. Year, 1933. United Kingdom, 103. United States, 95. Year, 1934. United Kingdom, 125. United States, 116. The stock market boom in the United States was really much more drastic than is indicated by these index numbers, because these are yearly averages and include sluggish stocks as well as market leaders. The boom began as far back as 1924, as can be seen, and reached its peak in the fall of 1929. By the spring of 1929, it had become a frenzy and was having profound effects on business activity, on domestic and international finance, on the domestic affairs of foreign countries, and on the psychology and modes of life of Americans. Among the financial results of the stock market boom were the following. In the United States, credit was diverted from production to speculation, and increasing amounts of funds were being drained from the economic system into the stock market, where they circulated around and around, building up the prices of securities. In Germany, it became increasingly difficult to borrow from the United States, and the foreign loans which kept the German financial system and the whole system of reparations and war debts functioning were shifted from long-term loans to precarious short-term credits. The results of this have been examined in the chapter on reparations. In other countries, funds tended to flow to the United States, where they could expect to roll up extraordinary earnings and capital gains in a relatively short time. This was especially true of funds from Britain, where the stock market boom ceased after the end of 1928. By that time, the fundamentally unsound economic conditions were beginning to break through the facade. The decline in foreign loans by both London and New York began to be noticeable by the last half of 1928 and made it evident that the chief support of the facade was vanishing. But the continued rise of security prices in New York continued to draw money from the rest of the world and from the productive and consumptive systems of the United States itself. Early in 1929, the Board of Governors of the Federal Reserve System became alarmed at the stock market speculation, especially at its draining credit from the industrial production. To curtail this, in April 1929, the Federal Reserve authorities called upon the member banks to reduce their loans on stock exchange collateral. At the same time, it engaged in open market operations, which reduced its holdings of bankers' acceptance from about $300 million to about $150 million. The sterilization of gold was made more drastic. It was hoped, in this way, to reduce the amount of credit available for speculation. Instead, the available credit went more and more to speculation and decreasingly to productive business. Call money rates in New York, which had reached 7% at the end of 1928, were at 13% by June 1929. In that month, the election of a Labour government in England so alarmed British capital that large amounts flowed to the United States and contributed further to the speculative frenzy. In August, the Federal Reserve discount rate was raised to 6%. By this time, it was becoming evident that the price of stocks were far above any value based on earning power, and that this earning power was beginning to decline because of the weakening of industrial activity. At this critical moment, on September 26, 1929, a minor financial panic in London, the Hatry case, caused the Bank of England to raise its bank rate from 4.5% to 6.5%. This was enough. British funds began to leave Wall Street, and the overinflated market commenced to sag. By the middle of October, the fall had become a panic. In the week of October 21st, on the Stock Exchange and the Curb Exchange in New York, total stocks sold averaged over 9 million a day, and on Thursday, October 24th, almost 19.25 million shares changed hands. The shrinkage in values was measured by several $billion a day. Some stocks fell by 100 or even 140 points in a day. Auburn fell 210 points, General Electric 79 points, and U.S. Steel 26 points in 4.5 days. By November 6th, these three stocks had fallen respectively 55, 78, and 28 points more. It was a financial disaster of unparalleled magnitude. The stock market crash reduced the volume of foreign lending from the United States to Europe, and these two events together tore away the facade which until then had concealed the fundamental maladjustments between production and consumption, between debts and ability to pay, between creditors and willingness to receive goods, between the theories of 1914 and the practices of 1928. Not only were these maladjustments revealed, but they began to be readjusted with a severity of degree and speed made all the worse by the fact that the adjustments had been so long delayed. Production began to fall to a level of consumption, creating idle men, idle factories, idle money, and idle resources. Debtors were called to account and found deficient. Creditors who had refused payment now sought it, but in vain. All values of real wealth shrank drastically.